Welcome back to the What's Your One More podcast. We are here for our final wrap up on the year for the lending update that we do once a month. And I have my continued co-host with me here today, Daniel Halverson, Area Manager with Bank of England. Thanks for joining me today.
Yeah, it's good to be back.
Yeah, man. So we've got, I think we've done like 6 of these already this year. And it is interesting how some of the notions that we've said from the month of August even till now are starting to show up a little bit. And we're going to talk a little bit about that as we get in here. But, for our audience, one of the things that I continue to see on the feedback side of stuff that we're getting, especially from our social media, and also some of the comments that we're getting on YouTube from this, is that people really are appreciating the take on why now to buy versus some of the things they're hearing in the news. And, I'm definitely glad that we're talking about that. But someone had asked some questions about, well, what if I want to wait and see if rates go down? Because you guys keep talking about rates go down, and we're going to talk about that as well. But we kind of have some options for people. If you're ready to buy now, if you're ready to take a look at something now, we've got some great options in this lending industry right now. And I'm just going to kick right off with that. So, I kind of like what you wrote in here. It's like, how low can you go? And so I'm just going to really just give it to you right there and say, hey, man, this is a great opportunity to kind of jump right in and talk about that.
Well, and just piggybacking off of, we talked about the 2-1 buy down being an option for buyers that ultimately want some short-term relief on their mortgage payment. And I just wanted to provide some context that there are additional options in addition to the 2-1 buy down. So essentially, for those that maybe haven't been following along, the way that the 2-1 buy down works is if your interest rate is locked on a 30-year loan, fixed rate at 6.5%. In year 1, that interest rate will be 4.5%. Year 2, 5.5%, and then year 3 through 30, your loan will be at 6.5%. So it's a fixed rate loan. You just get the relief in the first 2 years, hence the name 2-1 buy down. But there are a couple of other options as well, one of which is called a 1-0 buy down. And as you might expect, same scenario if you're locked in at a 6.5% interest rate. Interest rates 5.5 for year 1, and then year 2 to 30, you're fixed at the 6.5% rate. And then there's a 3-2-1 buy down, and ultimately, like you would guess, year 1, 3.5, year 2, 4.5, year 3, 5.5, and then year 4 through 30, 6.5. And I don't anticipate that we'll get a 4-3-2-1, but we'll certainly stay tuned for that.
Right.
And it's important really to note the reason for the different options. The primary reason that we would point that out is that the cost of the 1-0 versus the 2-1 versus the 3-2-1, as you might expect, the cost, the more rate relief you get, the higher the cost. Yeah. So
I think this is interesting. It's worth talking about for just a second there.
Yeah, and the way that these programs work is it's a fixed rate loan. The interest differential for the temporary periods is just subsidized at closing. And so in the case of just the 1-year buy down, that cost is generally less than 1% of the loan amount. The 2-1 buy down, it's generally about 2.3%, and then the 3-2-1 is generally close to about 4.5% of the loan amount.
And Daniel, who's paying for these costs?
Well, the way that these programs work, it really only works if the seller or a builder, a third party, is contributing a majority of that cost. And the reason being, let's take the case of the 3-2-1 buy down.
Yeah.
The cost of that being 4.5%, it being that significant, I mean, you really have to have. It's really more, I think, geared towards a builder type of a product. And
exactly.
You're really not, you wouldn't really necessarily expect to go into a negotiation with a seller and get a 4.5% credit from the seller.
And for our audience, let's back up here a little bit, just because I know sometimes you and I, we talk this lingo, we go back and forth. And for us, it's like just, pow, 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 and here we go. We understand what we're saying. But I often get asked this 4.5%, like, what do you mean 4.5% of what? What does that really mean? So break that down just a little bit so everyone understands. Let's use a basic, just for simple math, $400,000. We're using $400,000, and let's just say that 4.5% that you're talking about there, and that might not be simple math as we're looking at here, but you get the drift here. 4.5%. That's roughly $18,000.
That's correct.
In cost. So that's 4.5% of $400,000. That's $1,800,000, assuming the loan amount's $400,000, of course. That's 4.5% of that loan amount. Someone has to pay that in that 3-2-1 buy down case. So that's $18,000, which, to your point, which is why you typically see that more attractive in the builder's market than a traditional resale market, because a traditional seller isn't looking to give up $18,000 right away.
Correct. And in order to structure that as a cost to the buyer, in many cases, they can't pay points in an amount great enough to stay within federal regulations. So as a buyer, think about it. I can't pay the cost of the buy down because at that point, the lender would have to pass that cost to me in the form of discount points.
Right.
And I can't actually pay that cost in staying with QM loan guidelines.
So a compliance guideline.
Exactly correct. So that's why we say this is a program that's geared towards a third party contributing a majority of that cost, because in some cases, without that contribution from a third party, there would be no way for a lender to offer that product.
Right. And there's a trick to this. You could have buyer contribute and seller contribute to kind of split that cost to meet the compliance. So if you are doing with a resale and you are interested in this product, there's a way to make it work, but it's going to have to be split cost.
Correct.
Okay.
Correct.
So of these three options, you're out there, you see this all the time. Which one of these is the most popular and why?
I think the 2-1 buy down is the most well known because it was the first one that kind of came back to market. So the 2-1 buy down led the market by probably at least a couple of months before the 1-0 and then the 3-2-1s. They've kind of come out in waves as far as how they've been reintroduced back into the market. So I think that most people are most familiar with the 2-1 buy down, but in terms of which one really has the most staying power, the 1-0 buy down, in my opinion, probably has the most staying power when you're talking about a resale market, because the cost is more reasonable. At 0.75%,
right,
of 1% of the loan
very
amount,
affordable,
is a lot more easy to negotiate. Or if a lender wanted to provide that as a true lender paid incentive, that's much more attainable than trying to build a much larger percentage into the pricing, essentially.
So there's besides the obvious relief, there's a hidden gem in this product, and I really want our listeners to kind of tap into this one, because this goes way overlooked. And I would say that when it first came out, everyone was just so thrilled with the rate relief, they forgot about this. The money that's prepaid, because essentially you are prepaying that differential of interest between year, let's assume 1 and 2, and in some cases 3, that money is sitting in an escrow account essentially. So Daniel, what happens if I'm a buyer and I buy on your 2-1 program and then all of a sudden rates drop in the next 6 months or a year and I want to refinance, but the seller prepaid that interest differential in that 2-1 buy down? What can I do with that money?
Yeah, any of that interest, if the loan is paid off via refinance or sale before that period is over, it's essentially applied as a principal reduction.
Okay, so it reduces my principal balance.
Exactly correct. So if you're in the camp of, well, interest rates could go down and I could refinance this loan, then this is a product that still has an appeal for you, because that's not money lost by any means, as opposed to if you chose to take that money and allocate it towards discount points, well, that money would be lost. Generally speaking, you wouldn't have held the loan long enough to recoup the cost associated with that upfront investment. So the 2-1 or the buy downs in general, they have that added feature of, if you were to refinance the loan when rates go down, you don't lose any of that money. It's simply applied to your loan. Whatever the remaining differential is applied to your loan as principal reduction. Yeah,
I love that feature. And could it be that some lenders market this as you can use that towards your refinance because you are essentially reducing your cost? You're going to see some lenders maybe advertise that as you can use that money towards the refinance cost of your loan or towards the cost of a new loan.
Yeah, and I think that it's really just good marketing, realistically, in my opinion. So yeah, that's something that you may certainly see lenders advertise that.
Yeah, so that is something that is, as a consumer, as a buyer, I'm going to think about like, wow, I could take advantage of this, someone else pay it, and now I can reuse that money towards my benefit if the rates come back down. What a wonderful product. It's great to see this kind of make their way to the market in multiple facets. So FHA released some news. Now, the reason this is interesting, I'll let you talk about it, is the flood insurance is now, they're going to allow private flood insurance on the market for FHA loans, and kind of talk to them about why that's a big deal and how we got to that level.
So historically, up until very recently, flood insurance was only available through the National Flood Insurance Program, so FEMA policies essentially. And the premium was set based on whatever rates they had come up with. And private flood insurance entered the market fairly recently on the conventional loan side. And essentially, as you might guess, there are private companies outside of the NFIP that are issuing flood insurance policies.
NFIP is National Flood Insurance.
Correct, National Flood Insurance Program. And generally speaking, well, it kind of depends, but generally speaking, those policies could be cheaper than FEMA policies. So conventional financing allowed for more flexibility there if you have a situation where customer is not comfortable with the cost of flood insurance. Now they've got another option to go look at private flood insurance policies as well. FHA, while they did allow for companies, third-party companies to write policies through FEMA, they didn't allow private flood insurance. But now they've recently said, as of effective of December 21st of this year, so just a few weeks from now, essentially they will allow for private flood insurance. So FHA buyers have options there to help make those payments a lot more affordable if they purchase a property that is determined to be in a flood zone that would require flood insurance.
So this is a big deal because if you're on a coastal state, or if you're in a state that has a lot of floods, or maybe you're not in a state that has a lot of floods, but you're maybe in a 100-year flood zone, trust me, we've seen it happen. Floods do happen, but it also affects and impacts the debt-to-income ratio and the borrowing ability of the borrower, and the list of things go on and on and on. And to have an ability to have a secondary outlet to choose from is a big deal, because sometimes those NFIP policies you refer to, they just get lumped in, and then everyone gets the same cost, and you're kind of paying for certain areas versus the ones that private are saying, I'm going to take a little more risk on this and not charge you as much because I don't feel like it's as risky of an environment as maybe someone that lives right on the ocean or lives right on the intercoastal. So there's some wins with that are nice to see come to the FHA market.
I think it's a huge win from an affordability standpoint. Obviously, anytime you can give additional options and not be captive to having to use one particular insurance option, that's generally a good thing for the market. So it really is a big win here, and I think that a lot of buyers using FHA financing will benefit from this.
So I feel like this is a lending update full of wins, because here comes another one right at you here. We have the conforming loan limits that the Federal Housing Finance Agency has rolled out. Now, keep in mind, Daniel, when you started, I believe conforming limits were like 417. When I was doing loans, they were 280, 500. We're about to talk about a 726,200 new conforming limit. That means you could put 5% down, in some cases 3%. You could put 5% if you did qualify for that, but 5% down for 726,000. That is just mind-baffling, and that is all based on an appreciation schedule that comes out each month from the Federal Housing Finance Agency, where they do a look back from the previous 2 months, and they continue to show the appreciation rate over each month, and they develop a composite. And the differential between this year's composite and last year's composite reflects a difference of $79,000 in the new conforming loan limit, and this is spread out around all those different appreciation schedules of the United States. $726,200. Like, what's going through your head when you hear that?
Well, I think first and foremost, it's even higher than maybe what we anticipated, or at least myself speaking, what I would have anticipated. And I was kind of curious to see, because a lot of lenders this year jumped the gun on basically allowing for conventional loans.
Yeah, we talked about that two months ago.
Above the 647,200 number. And they capped it at 715, and then a couple of readings came out with showing appreciation slowing, and they rolled that back a little bit, and some investors rolled it back to 700,000. So I was curious to see kind of where we would land. So to land at 726,200 was a little bit of a surprise in a good way, based on what I was expecting. And I just did a quick look back yesterday when this was announced a couple of days ago, but I just did a look back, and from 2006 to 2016. The conforming loan limit was at 417,000.
For 10 years, it remained the same.
And since that time, now we've got a 74% increase in a 6-year span. So it was super interesting and eye-opening to see that kind of a differential.
So I just want to take that for a second. So for 6 years, 74% increase. What's interesting to me about what you just said there is that is a number that is pulled. The increase there is pulled based on monthly appreciation. So what I'm hearing is that real estate has increased 74% around the country since 2016 till now.
Yeah, I think that's a conclusion you could certainly arrive at.
So if you can invest in something over 6 years and garner 74% return, that doesn't sound like a bad deal to me.
I think you'd probably have a pretty easy time raising capital for
Yeah,
that.
that's a pretty good portfolio right there. That's not a bad gig. So not only in the conventional world, we also had news in the FHA world. You want to update us on that? Now, this is different per county, of course, but...
Yeah, before we get to that, I also want to point out that VA loans follow conforming loan limits.
Good point.
So now you've got a 726,200 loan on the VA side as well, which the way that really translates to the market is if a VA buyer has an existing VA loan right now, there's a remaining entitlement calculation that determines how much they can purchase with 100% financing. Mm-hmm. So once you've used up that entitlement, at that point, a down payment is required. So for people that want a situation where maybe you've already got a VA loan and you're purchasing another one, you're able to purchase and get a much larger loan on another property when these loan limits increase. I think that's really the impact for a VA buyer.
Yeah, no, it's great. I think it's awesome. And then, go into the VA, excuse me, the FHA side of things. Now, remember, this is per county. That's the weird thing about FHA. Everything's county basis or MSA basis. So in this particular section, you're probably going to talk a little bit about the MSA of Jacksonville, but we can also kind of break down a little bit of the, sometimes there's this baseline FHA loan limit around the country. I believe that's like 426 or something in that nature. But it's higher per county in other areas that have higher affordability issues. So I'll let you kind of take it from there.
Yeah, and I only pulled the numbers here for our market as it pertains to these loan limits. But essentially, we went from 432 400 to 526 700.
Yeah.
So what is that? It's almost a $100,000 increase, a $95,000 increase there, and that is for the Jacksonville metro. So that's Duval, Clay, St. John's, Nassau, and Baker counties.
And if you're looking for your metro, in our show notes, just click on the bottom there. We're going to have the HUD link. You just put in your state, and you can go examine the counties to see exactly what your new loan limit is. But I can guarantee you it's higher than what it was prior to.
And it's, once again, it's interesting to think that we're almost at what the conforming loan limit was
when you started
just a couple of years ago. And the conforming loan limit was 548 250 very recently, and now the FHA loan limit a couple of years later is pushing that number. And last thing I'll say on that is keep in mind for conforming loans, FHA loans, and VA loans, these loan limits increase if you're talking about a 2, 3, or 4 unit property.
Yeah, I'm glad you brought that up.
So you've got, on the FHA side, in our market, you can now purchase a 4 unit property and get a loan in excess of $1 million, which is a pretty eye-opening thought. And, on the conforming side, it's almost $1.4 million of a loan you can get on a 4 unit and still be considered a conventional loan. So pretty eye-popping numbers when you take a look at them.
Yeah, no, it is definitely a lot to take in, but the opportunities are endless when you take a look at that, whether you're an investor, whether you're a primary residence purchasing, a quadplex, or however you choose to scope that. There's endless opportunities there that we didn't have even 2 years ago.
Without a doubt.
So pretty cool to see. So here's the question we get asked every single day. We've been talking about it over and over again on our podcast. What's the latest on mortgage rates? And just to kind of bring our listeners up to speed, if you haven't heard one of our podcasts yet, we are proponents of, we've believed since the rates peaked at 7.5 that they would continue to make their way down for multiple reasons. Check out episode 9, check out episode 10. We continue to go into deep detail with a guest on the show as well, Dan Habib, who's also an economist, who goes into why he shares the same beliefs we do on this. But in today's portion, we won't dive into that again and regurgitate what we already talked about, but rates are kind of starting to slide back a little bit. And I'm not here to say that I told you so yet. We've been called crazy. We've been called a lot of things by a lot of people saying there's no way we're going to be back in the 5s. And here we are today, 6.25. We're hovering that area. And very cheaply, could you get to 5.875? And it's not going to take much to push it back over the edge. So talk to us briefly about where we stand on the mortgage rates.
I feel like every time I'm on here, we talk about rates, but it's the hot topic of conversation, and not just real estate. I mean, the economy in general is heavily impacted by what's going on with interest rates right now. But obviously in our world, mortgage rates have been all of the buzz and kind of have a lot of people in wait and see mode. But the big thing that we've talked about is with respect to the inflation readings. You've got from October of 21 through June of 22, you've got really elevated inflation readings. So inflation was really hot during that time. And what we're seeing over the past 2 months here is moderate inflation. So the readings are still positive. In the October CPI reading basically came in at 0.4%. So it's still a positive number. But because the number that is being replaced was so much higher, moderate inflation is causing inflation to go down. So we went from 8.2% to 7.7% on inflation. If you look at core inflation, which basically strips out food and energy costs, once again, we went up by 0.3%. So we had inflation, but because we were replacing a higher reading, inflation went from 6.6 to 6.3%. That was October. And basically what happened in October is when that information came out, November 10th sparked the biggest rally in mortgage-backed securities since they've recorded that information. So
CPI goes down, biggest rally in the mortgage market we've seen since they started recording that data.
That is correct. So that is the October inflation data, just for set the record there. But I think it's important context because we talked about this. We've talked about this a good bit. That moderate inflation will bring the inflation readings down.
Absolutely.
And when the inflation readings come down, that's a good thing for mortgage bonds.
And maybe we just back up for just a second before we go any further. Just for our listeners, very quickly, there's three forms of inflation. There's CPI, which is the Consumer Price Index, right? Then there's PCE, which is what the Federal Reserve uses to measure inflation. That's their favorite form of inflationary measurement, which is personal consumption expenditures. And then you have the PPI, which is the price production, producer price index. Thank you.
Yep.
And that's that's the one that says, hey, listen, if I'm making this cup that I'm drinking water out of, and it costs more money for me to make this cup, how much do I take on before I pass it down to the consumer? All three of these are above where they normally are. All three of these are very elevated right now. Each one of them gets a new reading each month for the previous month. So whatever comes in November is representing October's, and so forth and so on. And each one of them come in at a different time. They don't all hit at the same time. So we've got three levels of inflation that hit each month. And the one the Federal Reserve pays the most attention to is the PCE, which just came out yesterday. We're going to talk about that briefly. But the CPI is real close right now. The CPI is a real close level they're looking at. And the CPI is also what I-bonds are measured off of. And then the PPI really just doesn't get as much respect, but it's getting a lot of attention right now. Because if prices continue to go up on the production side, that's eventually going to make its way to the consumer side. So I just wanted to set the stage for that as you're talking about this CPI right now and what's to come.
Absolutely. And I think that while we do believe interest rates will come down, we're in the camp of people that believe that we will see interest rates come down. We don't know timing-wise, nobody obviously knows, but we don't know timing-wise exactly when that's going to happen.
Right.
We don't know if we may experience some highs and lows with inflation, or with rates. So that's not to say that rates will stay low over the course of a long period of time, but we do believe that we will see interest rates come down fairly considerably. I will say that there will be some volatility. There will be some bumps in the road. I don't think we're headed for a straight downward line to lower mortgage rates by February, March, April of next year. But I do think that you're starting to see the signs of the things that we've talked about, and you're starting to find further reason to believe that we're going to see some more moderate inflation readings replacing elevated readings, and that's really where we're getting this thought process from.
Because you're replacing the reading from the last year with this congruent month. So the one that just came out that shows for October, we're replacing October of last year. So we kind of have this future of what we're looking at by looking into the past. We know if we replace a higher reading with this moderate reading, that the average is going to come down.
Correct. And
therefore leading us to believe that the index comes down, which the rates will come down. That's where we're going with our forecast.
And the inflation readings were so elevated for those readings that I just mentioned that even if there's still inflation, but it's just not as much inflation, the readings will come down. So we're saying we could still have inflation and the readings could come down.
Right.
And that's the big takeaway of why we feel the way that we feel.
Yeah, great point. And on, yesterday, as we record this on Friday the 2nd, on December 1st, the PCE reading came out. And it came in slightly below expectation, right? Which is good. Anything below expectation is good. But it replaced a previous reading, to your point, that was higher. So it was moderate inflation that replaced a higher elevated inflation. So we see some wins in that on the rate side. And we're seeing the Treasury make its way back down. The last time we were talking, the 10-year Treasury was 3.839. It's 3.57, 3.58 right now. For our audience, as that comes down, rates come down with it as well. So everything that we've been forecasting thus far has happened slowly. It's gradually getting there. And if you recall, we went back and said first quarter, we think we're going to be in the fives. We're wrapping up to the end of the year here. We could see it even happen at the end of the year. I doubt it, but we could. On the 14th, we get the CPI index, and that'll also be another windfall of hopeful success, or we hit the pause button.
Yeah, and the PCE reading that we just got would normally be nothing to be excited about from an economic standpoint. But because the readings were so much higher, that was a win.
Yep.
But I also think it's important to just make note briefly that the owner's equivalent rent portion of inflation readings, that data lags pretty significantly, and over the next few months, that portion of inflation is going to be considerably lower, which is also going to drive inflation down. We think it could be a significant change there. So the owner's equivalent rent, which we could certainly get more into at a later time as far as a deeper dive, but there's reason to believe that owner's equivalent rent number, which that data lags pretty significantly, will start to come down. And I forget which index it is, but it represents, I think, 39% of the inflation.
It's the largest reading of inflation.
So if that number starts to come down, now 39% of what is tracked in these inflation reports that come down is going to be coming down considerably. Mm-hmm. So it's just something to keep an eye on, and something that further illustrates the point that we've been trying to make.
Yeah, and just real quickly, I mean, we don't have to get into it, but I think it's hilarious. Owner's equivalent rent. It goes a little something like this. I'm going to call you Daniel. Hey, Daniel, and you're going to pick up your like, hey, this is such and such. I'm conducting this survey. I know you own your home, but if you were going to rent your home, what would you rent it for? And you're going to say a number. And I'm going to go, thank you. And that's how that's accounted for. That is not, I mean, many people will argue that is an outdated way of conducting that information, but it's what we have to work with. And it's consistently bad, but it's what we have to work with.
I think you could probably point to a number of flaws in a lot of the data that we receive, but we take the data that we have and we try to interpret it and forecast based on the best information that we have.
Yeah, some might say a lot of the governmental measurements that we get right now favor whoever's in office, right? A lot of people say that there's a lot of fallacies in the indexes we're getting now and have gotten in the past too. So it's whatever boost and benefits who's in office is the information and how it's measured right now. And so sometimes as we look at this, we often question the legitimacy of what we're getting here, but it's the tools we have to work with nonetheless.
That is absolutely the case.
So, well, that's all we got for our lending update here. And Daniel, always glad having you on the show here, man. Appreciate your insight and your ground level expertise that you bring to the show. Very much appreciated. Again, for those of you who want to hear more about this, check us out on our YouTube channel at What's Your One More. Check us out at Apple and Spotify podcasts at What's Your One More. And then also check us out on our social medias at What's Your One More. We'd love to hear from you and hear your feedback as well. Thanks again.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so I put my all into it, yeah.